Hello, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. My name is Jay Gragnani. Here joining us this week is Will Gibson. Will, thanks for joining us. Great to have you on, and appreciate everybody taking time to listen to us today. Today, with everything going on in the market, summer months are officially upon us with June being here. The first few days of June are behind us. The temperatures here in Richmond, Virginia over the weekend certainly felt like summer, hitting the mid 90s, hot and humid. The sun is shining. And as a result, there's a lot of discussions going on around vacation schedules, where people are going to go, what's going to happen. And the way that people are going to go on vacation is by consuming some form of energy, whether it be gasoline for their cars, whether it be jet fuel, whatever it might be. There is certainly a big speculation that energy space is going to see an influx in demand over the course of the summer. And when we look out at the equity markets for energy as well as commodities, we continue to see positive signs across both of those. And so what we wanted to do today is spend a little time breaking that down, looking at energy, the energy stocks, where we see strength within the energy sector, as well as where we see strength within the commodities market, specifically as it relates to a number of the energy related commodities. And so with that, energy, we're certainly seeing a lot of talk and rhetoric around the demand for energy going into the summer. But really, so far this year, the story really has been, in the equity markets at least, is the leadership of the energy sector. And to put that into perspective, consider that the energy sector this year is up about 47%. And that is looking at the Energy Select Sector Spider, XLE, through market close on Friday. Energy is up about 47%. Now, that is the best performing sector. I think it is worth mentioning this year, all broad sectors are up. And I think that speaks to just the breadth of the strength that we've seen in general, but very much so, energy is the sector that is hands down been the best performing sector so far this year. And it's done so by a pretty wide margin. I mean, the worst performing sector this year is utilities. And so if we look at that dispersion just this year, the difference between energy and utilities, there's about a 37%, almost 38% dispersion between the best sector being energy and the worst sector being utilities, about 38%. To put that into, 43%. There's a 43% dispersion between the best performing sector energy and the worst performing sector utilities. That already, not even halfway through the year, is more than the average dispersion that we've seen over the past 15 years, which is about 38%. And so last year, you saw very wide dispersion in returns. It was just very different than this year, where energy was the worst performing sector last year, down 37% when all was said and done. Despite the big rally off the bottom, energy stocks are still down about 37%, while technology was the best performing sector. And really, last year was in many ways more of the same for the energy sector and the technology sector. If we look at a period from 2014 through the end of 2020, so for that 6-year stretch, the energy sector was the worst performing sector in 5 out of those 6 years, whereas technology was the best performing sector in 3 out of those 6 years, and was certainly up there towards the top, the best performing over that entire time period. That dynamic has dramatically shifted, though, as energy has moved into a leadership position across a number of different fronts, whereas technology, we've seen weakness across the technology sector there. So, we mentioned that the strength, obviously, not only in terms of performance, where energy has been the best performing sector this year, but we're very much and have seen energy as a group across the board move into a strong relative strength position and really becoming a dominant leader from a market perspective.
Yeah, Jay, that's definitely right. And honing in on that relative strength perspective, not just absolute price movement, but on that relative basis, you've really seen that across a number of our indicators. A couple that I'm going to mention here is one, Dolly, that we saw energy move up to that top ranked position really about the end of February, but really before that, you saw it make a big run from sitting at 11th at the end of 2020, so November 2020, kind of when we got that vaccine announcement. And then you saw a strong rebound going from 11th to 4th in a matter of about 2 months. And then now where it sits, still in the top third of the sector ranking. So that's one area that points to energy's kind of relative macro strength. The other that I wanted to spend a moment on as well is on the asset class group scores page. So if you're not familiar with that, it's just where we're ranking groups on our platform, about 135 groups by their average fund score, which is looking at ETFs and mutual funds that represent that group, and we're averaging them together to get an average technical reading or technical score for that group called fund score. So the energy natural resources group right now has a fund score of 4.2. And on a scale of 0 to 6, 0 being the worst, 6 being the best, a 4.2 clocks in at a pretty optimal or very strong fund score. It puts it in the blue sky zone, as we call it on our page, if you're familiar with that. So out of all 135 groups, that sits 12th. And that's very notable on a relative basis. And something that I also kind of wanted to mention on this topic is that 4.21 is not a common theme. In fact, really anything north of the 4.0 threshold for this group has been rare in the past. This is the group Energy Natural Resources has only cleared that 4.0 fund score threshold really a handful of times. The last time that we've really seen it apart from this year was in 2008. So that was actually on the way down after the June peak. But by and large, now the sector is by and large trending higher and carrying a lot of relative strength in its favor, score directions, all of that counting positively for the energy sector. And one more thing, Jay, that I'm going to toss in here real quick. And I know we had a conversation about this offline, but when we were looking at energy, you don't only have to play energy through getting crude exposure or getting energy exposure through like a major spider fund. There are some other areas of the market that tend to move not with energy explicitly, but tend to trend in that direction. And we looked at this in our report a few weeks back. We calculated crude oil betas. What all that was telling us is, the risk or the relative volatility in the movement of what other groups in the equity space tend to correlate with crude. And some interesting areas that are aligned right now, you see financials and industrials, you see small caps, you see Latin America tend to move or correlate in that direction with crude prices. And Jay, right now we're really seeing that from a lot of the relative strength rankings, in addition to where energy is positioned right now.
Yeah, you're absolutely right. I mean, you mentioned financials certainly is the second best performing sector so far this year, and we've seen a lot of strength out of that group as well. But you're absolutely right, and you mentioned some of the group scores and the Dolly rankings and those types of things, and the way sectors and groups move up those rankings is not by one or two stocks or one or two subgroups of that sector doing well. It's really looking at the broad strength across all energy names. And we talk a lot about XLE for the energy space as a benchmark for that group. And XLE is the largest energy-based ETF that's based on the S&P 500 energy sector ETF, but it's very much a top-heavy ETF in the sense that Exxon and Chevron account for nearly about 45%, nearly 50%, but about 45% of the movement of XLE is directly attributable to Exxon and Chevron. So those two massive companies just control a lot of that ETF. With that said, when you look at something like RYE, which is the Invesco equal weighted S&P 500 energy ETF, the performance of RYE has actually been a little bit better than that of XLE this year. And that's just simply taking all of the same energy companies and equal weighting them. So each company in that index receives the same weight as every other. So Exxon and Chevron are not treated any differently just because they're much bigger companies, but they're given the exact same weight as every other stock within there. And that ETF, again, is up a little bit more. And so what that really tells us is that yes, while some of the big behemoth energy companies are doing well, it's really been about the breadth of the strength across energy and across a lot of the individual stocks, to the extent that we are seeing a majority of those energy stocks are in positive trends today. And that's something that we have talked about over the years, is just identifying positive trends. And one of the things that I always remember when I first started at Dorsey Wright was, Tom Dorsey talking about, look, if you could do one thing to improve your portfolio, is that don't buy stocks in negative trends, only buy stocks in positive trends. And that's something that has just always stuck with me over the years. And it's very simply because the only way a stock stays in a positive trend is for it to move higher in absolute price. If the price of the stock falls and keeps falling, then it is going to violate its trend line and move into a negative trend. But if it keeps moving higher, the trend line keeps moving up with it, that stock stays in a positive trend only to the extent that it continue to push higher in absolute price. And what we can do with that information is, for all energy stocks, as an example, we can look at what percent of all of those stocks are trading in positive trends and then plot that. And so we do that, what we call our PT indicators, which stands for positive trend. It's just simply what percent of stocks within whatever universe we're looking at. In this case here, we're talking about all energy stocks, but we track PT indicators for lots of different universes, including the S&P 500 names, including NYSE stocks, OTC stocks, and the likes. But if we look at that number, ideally what we want to see on those PT indicators is readings north of 50. What that suggests is, generally speaking, a majority of that inventory, a majority of that universe that we're looking at, the majority is in positive trends. Typically, when we see that happen, that tends to be a good thing for that particular universe. Or if we're looking at like the PT for the S&P 500, PT SPX, a reading above 50% tends to just be a good sign for the market, a healthy environment where more stocks than not are in positive trends. And that's absolutely the case for energy today. I mean, that reading's at 56%. It's not super high, but it is at 56%. Will, which, as you alluded to, I mean, that's the highest that we've seen in about 6 years. For the better part of the past 6 years, outside of about a month in January of 2017, the vast majority of the past 6 years, we've seen a reading on that PT energy chart below 50%. Suggesting that a majority of energy stocks for the better part of the past 6 years were in negative trends. That dynamic, that is different today. And that's one of those things that, we've seen over the years, while energy was performing poorly, we've seen energy go in fits and starts, where you might see some near-term rally, but no follow through. And then that rally kind of peters out and moves lower. If I had to say, why is this time different? Well, you're seeing things like the PT for the energy sector above 50%, which is just not something you've seen in a while. And so, when we look at the rally this time, as opposed to say something like back in 2016, that is one of the things that we're seeing that is different. In addition to, Will, a lot of the stuff that you mentioned around the Dolly rankings, the asset class group scores, and the like. So again, that was more of just, the strength that we're seeing in energy is not specific to one particular cap-weighted ETF or a handful of stocks. It really has been a story about broad strength across the board. Certainly on the heels of news around demand, economy opening back up, energy usage, and that all the energy companies certainly are benefiting from that. We've also seen the commodities market show positive signs as it relates to things like crude oil, very specifically moving back to 52-week highs, not anywhere near the June 2008 all-time high of $147 a barrel, but pushing back pretty close to $70 a barrel here recently and hitting new 52-week highs.
Yeah, Jay, those are great comments, and I'm glad you added the point about what looks different this time technically than some of those run-ups of times past, things that ended up manifesting in a trade more or less of a longer-term trend or not a longer-term trend in the past. And one other thing that I would add is that right now, there's no shortage of anecdotes that are trying to point to market tops or trying to point to tops within various sectors. And energy, like you said, we see a lot of just technical health in addition to some qualitative health that you mentioned about a reopening economy and a lot of other tailwinds that could support that. But again, from the technical point, we're seeing things that we really haven't seen in 6 years, whether it's PT, whether it's group scores. And that said, there is no shortage of, you do see some speculation in the space. You do see some moments of froth. For example, if you're familiar with our implied momentum bell curves on the platform, We tend to reference those in relation to the broad market, but for individual sectors, it's just using option pricing to say, what volatility is justified for this current price to be so in short. And right now, if you look at just the energy sector, you are going to see a bit of a rightward skew. So the most rightward skewed of all the sectors. But I would emphasize that you typically don't see these types of breadth thrusts or these types of participation when the sector is in a downtrend or when the sector is rolling over. Like the broad market, you typically see those breadth thrusts and healthy uptrends. So that is one way to kind of navigate if you're looking across chart, seeing some very overbought conditions. If anything, maybe that's an opportunity to dollar cost in, get in on a bit of pullbacks. But Jay, I mean, one other more kind of frothy note I'll say about the sector amidst the overall positive evidence that we've said. One more frothy note or kind of more speculative thing is I saw this in the Wall Street Journal this morning that $100 WTI, so West Texas Intermediate, $100 WTI calls are now the most widely owned contracts on the New York Mercantile Exchange. And I mean, keep in mind that should these leveraged bets kind of move into the money, Jay, you mentioned this before, but this would mark the highest price for crude in over six and a half years. So there is a fair amount of investor speculation, but also just investor researched expectation that crude prices are expected to trend higher from here, Jay. And from a relative strength perspective, I'm probably going to pass back to you and say, given energy's weighting in the S&P 500 on a cap weighted basis, we've talked about this before, where it's really paid this year to be overweight that space on a relative basis, because the market wise, you're not going to be able to get that exposure and that contribution from the energy sector in just a more passive vehicle.
Yeah, you're absolutely right. I mean, if you look at the S&P 500, about 3% is invested in energy in the S&P 500. So SPY being the cap-weighted S&P 500, about 3% of that ETF is energy. And so, a strong energy market, certainly can play well into an investing plan that is incorporating relative strength, and especially if those looking to add alpha to a portfolio. If you're able to overweight energy, and it doesn't take a whole lot when energy is only 3% of the S&P 500, overweighting energy is certainly something that can have a meaningful difference in a portfolio, and even in an equal weighted fashion. Energy is a little bit more, about 4.5% in something like RSP, which is the S&P 500 equal weighted ETF. So either a lot of those broad benchmarks, there's just not a lot of individual energy exposure versus something like technology, to put it in perspective, is about 26% of the S&P 500. And that's, certainly a result of just what we've seen over the past number of years. And I mentioned technology as a sector being the best performing sector, 3 out of the past four years. And so as the stocks of those companies have exploded and have grown tremendously over the past number of years, so too has their market cap, which has meant that technology has become a more meaningful piece of the S&P 500. At over a quarter of the S&P 500 is technology stocks today versus just 3% for energy. So while energy has done extremely well, you don't necessarily see its impact on major cap-weighted benchmarks like the S&P 500. Nonetheless, there's a lot of opportunity, broadly speaking, across a number of different markets, whether you're looking at ETFs, individual stocks, mutual funds, lots of opportunities there, or whether you're looking at commodities. I mean, the flip side of energy being one of the most meaningless sectors in the S&P 500 is that the energy market is the most important in the vast majority of broad-based commodity markets, because much like the S&P 500 is capitalization weighted, meaning the biggest companies get the biggest weight. A lot of commodity benchmarks are production weighted, meaning the most commodities in production get the biggest weight, which is crude oil specifically, but energy at large when you start to account for gasoline and heating oil and as well as crude oil. And so there's energy is very much an important piece of the overall commodity market, and a big piece of why within our Dolly rankings, commodities has moved up to the number 2 ranked asset class over the course of the year as the energy markets and commodity markets have grown. And when you look at, again, even within commodities, it's not just crude oil that's doing well. It's heating oil, it's gasoline, all of those up there at the top of the matrix in terms of looking at individual commodities. While the number one ranked commodity, interestingly enough, is lean hogs. You see heating oil, crude oil, gasoline are all up there in the top 4 positions, right behind lean hogs. So the energy markets for as it relates to commodities are certainly strong and broad as well. When you're looking at that strength, and there's lots of different ways to gain exposure to energy through ETFs. The one thing I will mention, and I think it's important distinction, and probably something that many of you may have remembered conversations around this back in May of last year. I guess it would have been April of last year when the May crude oil futures contracts actually turned negative, is how a lot of these funds take exposure to crude oil. It's not like it's not a commodity like gold where you can just go buy physical bars of gold and put them in a vault and put them in a bank. And that's how a lot of the bigger gold ETFs are put together, where they are actually physically backed by bars of gold sitting in a vault. Crude oil, you can't do that. I mean, you're probably not buying big tanker ships and sitting them off the coast. Rather, to get exposure to crude oil, you're buying them through futures contracts. As a result, there's lots of different methodologies to do that. You could buy the front month and roll every month. You could just go 12 months out. You could go do a combination of that. You could do, there's a number of products out there that are called optimum roll yield, where they try to look out between 1 and 12 months and optimize the contracts to roll out to, such as to mitigate any negative impacts of backwardation and the option in the contract pricing. So I mentioned all that to say that there's lots of different ways to gain exposure to crude oil. Probably the most widely utilized is a product USO, which is the United States Oil Fund. But that one, again, is taking exposure to crude oil contracts. As a result, for investors, it does mean it will generate a K1 in a lot of cases. And so that's not neither here nor there, but it's something to just be aware of, be cognizant of if you're looking to gain exposure to crude oil. A lot of times, the vast majority of times, there will be K1 statements associated with that will, for tax reasons. There are products out there that do have a no K1 structure and still gain exposure to crude oil contracts. So those products do exist out there in the marketplace. But I guess the bigger story there is just understand what it is that you're buying, understand how that fund is gaining exposure to crude oil. So the expectations are there in terms of how, which contracts that they're buying and the likes from there. But lots of different ways, Will, to gain exposure to not only crude, but a lot of different commodities as well.
Yeah, Jay, I think those are great points of clarification, and we could certainly have a whole podcast dedicated to just commodities, some of the movement we've seen there, a lot of the mean reversions, a lot of the names that were up on stems pulled back lately. Some of the laggards like precious metals have shown a bit of strength, but we're going to save that for a different podcast in the future. And today we're probably going to go ahead and wrap up. But by and large, we see a lot of relative strength for energy, outpacing and really an overweight position in a lot of our models and sector allocations right now. We're seeing that absolute strength as well. We're seeing, a multi-year high of number of energy stocks and positive trends. You are seeing some near-term leverage and, speculation in the space and a bit of froth, but by and large, that's amidst a more broader positive technical backdrop. You have those other sectors that typically move or in tandem or correlate positively to energy movements also ranking at the top. So multiple arrows pointing to some strength in energy, and that's a trend that we're going to continue to watch and be overweight for the time being. But if you have any questions, we love to talk about this stuff. You can reach out to us at our main email, dwa@dorseyright.com. That's not a black box. We will get back to you as soon as possible, or you can reach out to us over phone, 804-320-8511. All that said, Jay, thanks for having me on this week. I hope everyone enjoyed it. We thank you for the attention, and we hope to speak with you soon.